So, what is the Federal Reserve? What is their primary function in our economic system? What are some of the tools they're using to influence our economic system? How is that affecting us as businesses and consumers? Most importantly for this video, how is it affecting mortgage rates? And we're going to cover all of that today in this video. But if you stick around to the end of the video, I'm actually going to lay out tools and the strategies that you can be exercising to actually keep up with the rise in mortgage rates so you aren't pushed out of the market or can get back into the housing market and still get your dream property. So let's get started. The Federal Reserve is the central banking system for the United States economy. It's created in December 23rd, 1913, after a series of financial panics. Basically, the government came together and decided we need to create an entity that will help stabilize the financial markets. Thus, the birth of the Federal Reserve. So what are their primary functions? There's several, but we're going to focus on one or two that are relevant to our topic today. The main function of the Federal Reserve is to maintain stability of the financial system and to contain systemic risk in the financial markets. They provide financial services to depository institutions, banks, and the U.S. government alike. So, what are the tools that they're using to influence their economy? What tools are they using to basically do their job in the economic system? Their main tool of a few is the federal funds rate, which is what you've been probably watching and seeing a lot of content around that they've been raising lately. COVID basically created an economic environment as to where inflation went through the roof. And the Federal Reserve's top tool to fight inflation is adjusting the federal funds rate. So what is it, how is it determined, and why is it important? Let's cover that really quickly. The term federal funds rate refers to the target interest rate set by the Federal Open Market Committee. This is a target rate at which commercial banks borrow and lend their excess reserves to each other overnight. The FOMC, or Federal Open Market Committee, which is a policy-making body of the Federal Reserve System, meets 8 times a year to set the target federal funds rate, which is the part of the monetary policy. This is used to promote economic growth. So, some key takeaways really quickly. This is the rate at which commercial banks borrow and lend their excess reserves to each other overnight. The FOMC sets a target federal funds rate 8 times a year based on the prevailing economic conditions, thus the conditions that COVID created, leading to them raising that rate. The federal funds rate can influence short-term rates on consumer loans and credit cards, which most of us are probably feeling at this point in time. Investors keep an eye out on the federal funds rate as well because it has an impact on the stock market. How is that? Well, basically, when they increase the rate, this is passed on to businesses and consumers, which we're going to cover in a second, making borrowing money for businesses really, really expensive. And this has a huge impact on that company's bottom line and the valuation of that company, hence why the stock market is going crazy. We're not going to go too far into that because right now we're focused on mortgage rates. So, what happens when the Fed raises the federal funds rate? When the Fed raises the federal funds target rate, the goal is to increase the cost of credit throughout the economy. Higher interest rates make the loans more expensive for both businesses and consumers, and everyone ends up spending more on interest payments. So those who can't or don't want to afford the higher payments postpone projects that involve financing. This decelerates the velocity of money in the financial system. It simultaneously encourages people to save money and earn higher interest rates on their funds. This reduces the supply of money in circulation, which tends to lower inflation and moderate economic activity, aka cool off the economy. So basically, inflation is going to be a lot of dollars chasing the same goods and services. So the Fed raising the federal funds rate reduces the amount of dollars in the system to chase those goods and services, thus keeping the price from spiking through the roof further. Okay, so here's another key point. When the Federal Reserve raises the rates, banks typically pass on the rate hikes to consumers, driving up the overall cost of borrowing in the U.S. that impacts the prospective home buyer, right? So let's take a look at another factor that actually influences mortgage rates other than the federal funds rate. Fixed rate mortgages are tied to the 10-year Treasury rate, which is a bond. When the rate goes up, the popular 30-year fixed rate mortgage tends to do the same, vice versa. Rates for fixed mortgages are also influenced by other factors such as supply and demand. When mortgage lenders have too much business, they raise rates to decrease the demand. When business is light, they tend to cut rates to attract more customers. Price inflation pushes on rates as well. When inflation is low, rates trend lower. When inflation picks up, i.e. right now, so do fixed rate mortgages. The secondary market where investors buy mortgage-backed securities plays a role too. Most lenders bundle the mortgages they underwrite and sell them in the secondary marketplace to investors. When investors' demand is high, meaning that there are a ton of investors chasing these mortgage-backed securities, mortgage rates trend a little lower because there's such a high demand. When investors aren't buying or aren't finding these mortgage-backed securities as attractive, rates may rise to attract more buyers. The Fed's actions do indirectly influence the rates consumers pay on fixed rate mortgages when they refinance or take out a new mortgage. So it indirectly influences it. It does not dictate or determine it. Okay, so you have a little bit of history and context on who the Federal Reserve is now, what role they play in the economy, and what tools they're using to influence the economy to basically try to stabilize the long-term health of the U.S. economy. We understand a little bit more now about how this all influences mortgage rates and why we've been seeing mortgage rates double in the last 10 months or so, pushing tens of thousands, if not hundreds of thousands of prospective buyers out of the housing market. So now, as promised, we're going to cover a technique or a strategy or some tools that you can leverage yourself to actually keep up with or maybe even outpace the rate hikes that are currently being conducted by the Federal Reserve, and thus pushing up mortgage rates. So the objective is for you to be able to, your target home, roughly how much your ideal home is going to cost. So what part of town you want to be in, the type of home you want, the neighborhood, etc. And based on your local real estate market, how much that's going to cost. When mortgage rates go up and the price of that property does not come down, which real estate tends to lag when rates fluctuate, then that means currently we're in this odd time where rates are intended to help compress or at least, moderate housing prices, but it hasn't done that yet. So the rates are up high and housing prices are still inching up in most markets, which pushes a lot of people out of the market or at least reduces the quality of home that they can buy. So what is it that you can be doing to compete with these rising rates and economic factors? How do you keep yourself in the striking range of the home that you truly want? Well, there's three major components that affect your affordability on buying a home. Number one is going to be your credit score, credit profile. We're going to put that together for now for the sake of this conversation. When you have a very healthy credit score, you ideally around a 740 to a 760 middle FICO score of your three FICO scores. And when you're applying for a mortgage, this will get you the best rate available from that particular lender or from prospective lenders. So that's one major component. What can you do to boost your credit score? And we're looking for boost to your credit score based on your primary trade line. You're not going to be able to go get a bunch of authorized user trade lines and boost your score and get the better rate and qualify for a mortgage. It's not going to work. Mortgage companies are advanced enough where they calculate out all authorized user, trade lines. They're going off of your primary trade lines on your credit report. So you're going to have to find a way to look at your credit score, look at your credit report, and see where it may be lagging or something that you can influence in the coming weeks or months that can increase your credit score if it's not already at that 740 to 760 mark. One really good tip is getting credit limit increases on your credit cards. If you can ideally do this without getting a hard inquiry, you really win. What you want to do is check out existing credit cards that you may have. If these are institutions or different companies that you have a healthy relationship with, you've been using the card effectively, you haven't had a credit limit increase in the last, we'll call it 6 months or more, and there are either some factors that have improved for you, or it maybe things have been stable, but you've just built a stronger relationship with that institution, or your credit profile has lengthened and improved, you may be able to apply for a credit limit increase, whether through your mobile app or, calling that company up, institution up, going into a branch if there's a local branch, wherever the case may be, you may be able to figure out how to get a credit limit increase on your credit card. And this is a phenomenal way to boost your credit because it immediately, once it reports, it immediately impacts your available credit, which impacts your utilization score, which is the second major factor in your credit score. So a credit limit increase is something that you can do that can immediately give a boost to your credit score. That's one. Number two is paying down your credit cards. Again, utilization. Payment history is the biggest, but it's very straightforward. Pay your bills on time. That's simple. When it comes to utilization, there's several components that affect utilization. Available credit, the available credit per card, the available credit total over all of your credit cards. There's subcategories there that influence the health of your utilization. So on top of credit limit increases, something very impactful you can do, actually two-pronged benefit we'll get into in a minute, is paying down your credit cards. The lower you can get your credit card balances, the better it reflects on your payments, on your credit report, and it's going to make your credit score increase significantly. Ideally, you want your balances in total and individually to be at or below 10%. You can pay it off in full every month. That's ideal. But if not, do your best to keep your credit limit, your credit base balances at or below 10% across all cards to the best of your ability. Or pay them down if you're looking to get in a home in the next 6, 12, or 24 months. The next major component after you get your credit score in its optimal position is going to be your income. Increasing your income. You will be surprised what another $5,000 a year or $10,000 a year in income can do for your affordability with a mortgage. Your mortgage affordability is strictly going to be essentially around monthly payments. It kind of doesn't matter how big the mortgage loan is as much as it does the monthly payment for the mortgage loan. It could be $1 million home, but if it's broken out over 40 years or 50 years and the payment is X amount of dollars, it doesn't matter. That $1 million sticker shock kind of goes out of the window because the amount of time you have to pay it and the payments agreed upon to pay it become affordable the longer the term. So really, mortgage payments are really what you're looking to manipulate. And you're doing that by the interest rate on that payment, the amount of spread between your monthly income and the next factor, which is your monthly expenses, your reported debt payments. So we're going back to the income factor. If you pull up a mortgage affordability calculator, which I recommend after this video you do, that'll be your homework assignment. Pull up Zillow, pull up Redfin, Google it, pull up a mortgage affordability calculator, plug in all the numbers that are applicable to your local real estate market when it comes to HOA, taxes, and insurance, and then focus on the interest rate, the term, the income aspect of it, and the monthly debt aspect of it. You will be astonished if you leave every other number fixed once you get it in there. If you can just play with the income portion, 5,000 more a year, 7,000 more a year, 10,000 more a year, how much more home you can afford. It's simple. Just simply $5,000 a year is a little over $400 a month. It's a little over $100 a week. Most of us can figure out a way to make another $100 a week. You can work overtime. You might be able to get a pay raise, something along those lines. It gets a little sticky if you're talking about commission income or tips. things of this nature, because you usually have to have that income for 2 years on your tax returns before it can count towards a mortgage. So be careful with that. We're going to focus a little bit more on W-2 income. That is really ideal because it's reportable and can be used in a mortgage application very early on, within 30 days of having that W-2 income, sometimes even sooner. Most lenders can deal with it. Obviously, you need to have a work history overall, but we're assuming all of that is in place. Get an extra income, ideally a W-2 income. You're going to need to, most likely, by mortgage loan requirements, have proof of 2 incomes for at least 2 years. That's another factor to keep in mind. A lot of people don't know that. In order to increase your income, ideally do it on your primary job, because you've probably been there already and that income will reflect. If you're trying to do it with a secondary W-2 income, there's a 2-year window in most cases with a lot of different loans that you have to have your first and second job at the same time for it to count. But W-2 income is optimal. The next thing is influencing your monthly debt payments. If you can reduce your monthly debt payments, that is actually more powerful on affordability than down payment money. Crazy, right? Having $30,000 to put down on affordability, and you can do this in the calculator. Please plug it into your affordability calculator as your homework assignment and watch this for yourself. It influences your affordability by $30,000. Take that same $30,000 and pay off your car, and let's say that car note was $500 a month. That $30,000 may open you up to $60,000, $70,000, $80,000 or more in affordability. It's insane. And the reason why is because your monthly expenses that are being recorded and your monthly income are all being averaged out for the life of that loan. So it may seem crazy to you because you're thinking about a shorter time frame, but they're doing this based on the fact that you're going to make that income and have those monthly expenses for the life of the loan. So when you pay off $300, $400, $500 a month in expenses, it looks wonderful because that's being averaged out over 30 years of the life of the loan. And that's why it's so impactful on your affordability on that home. Quick tip before we close this up. If you do have 1099 commission tip type income, something that you need to do, and we will talk more about this in more videos, maybe even make a specific topic out of this, you need to basically incorporate yourself, create some kind of LLC or business, and develop payroll for that income. This is going to allow you to take that income and convert it into W-2 income. Very, very powerful. It is really challenging when you're applying for mainstream institutions' lending products. We're talking about your everyday banks, lenders and creditors. Of course, there's fintech companies cropping up that are using these alternative data points, and that's fine. But at the end of the day, that's going to take years to truly roll out and be anywhere near the standard for lending. Right now, we're still in a time where it's really challenging to verify or use 1099, income or, business owner income, non-W-2 income to qualify for a loan, especially a home. So I recommend, for those of you out here, gig workers, freelancers, etc., and you have this income, look into incorporating yourself. An LLC is probably going to be fine, some type of business entity, do your research, and set up payroll providing services. There's several companies out there, you can find them, they're everywhere, that will help provide payroll. It takes a little setup, it's going to take a little legwork, but if you can get it done, your ability to be able to verify your income goes through the roof. And if you've seen in not only in this video, but other videos that I've done, I talk extensively about how powerful W-2 income can be when you're looking to borrow. So let's recap real quick. Your credit score, which influences the interest rate on that payment. Your income, your monthly debts, the term of the loan. The longer the term, the thinner the payments, the more you're going to be able to afford. Maximize your credit score, improve your monthly income, W-2 ideally, reduce your monthly debt payments that are showing up on your credit report, and do the longest term possible. Mix these together, and this is going to dramatically increase your ability to be able to get into your ideal home, even with the Fed rate hikes and mortgage rates climbing up like they're doing. You're going to outpace it. So I hope this was valuable for you. I look forward to bringing you more quality content and guidance along this process as we go through these crazy economic times. This is JP, your financial architect, helping you design your blueprint for prosperity. Stay focused, stay in motion. I'll see y'all soon.